Thanks, everyone. Welcome to the Seattle Angel Workshop Series. We do this as part of our efforts with the Seattle Angel Conference and our Transatlantic Angel Conference, of which we have many participants today from both of those programs. And at the moment, we're going to talk a little bit about deal terms and how to analyze the deals that are coming in at a pre-seed stage level with our wonderful Yoko Okano, who is the poster child, or one of many of our poster childs for our program, because she came through early in SAC and then became a fund manager, then created her First Row Partners fund. So Yoko, take it away.
Awesome. Thanks so much for having me. And yes, as John mentioned, both Minda, my partner, and I come from the Seattle Angel Conference world and community. I ran SAC 14, she ran SAC 16. And I can't believe, I think, did I hear a SAC 27 now?
Yep.
So kudos to John for minting so many new angels in our ecosystem. So, we're here to talk about pre-seed deal analysis for investors. Funny enough, this workshop is sort of an outgrowth of a due diligence deep dive workshop we do for founders. And inevitably, we do that workshop and a bunch of investors would show up and they're like, we want to understand what's going on like this side of the table too. So that the two workshops are sort of kind of the mirror of each other. For the founders who are in the room, what I heard a lot was super great. This is really key to understanding what's the thought process behind the folks across the table, right? So I will be talking through the content from sort of the investor lens, but always be thinking about it as like, okay, that's how people are hearing me, or this is the importance of the other side. I think, Bill, you mentioned that, right? Like you're doing opposition research effectively. But at pre-seed, we're not in such a contentious relationship. But we'll a little bit about us beyond what John had shared. First Row, we are a pre-seed specialist fund, and for us, what you'll hear a lot of how we think through deals. We'll share a little bit about our actual process, and so there is a software pre-seed US bent on our perspective. But I think the concepts that we mentioned are very applicable to scientific innovation, to impact, to to whatever sector you're really excited about. I don't think the specifics of what it looks like might be a little different in terms of like what you're looking for, but sort of the breakdown of how you look at a deal and kind of analyze it should be fairly applicable. So hopefully you'll find that and really excited to dig in. So we have about 24 portfolio companies across North America. About a quarter of that is in the Pacific Northwest. Minda and I both sit in Seattle. We are, I would say Seattle, Pacific Northwest kids to the core. So lots of pride here, but we do invest quite a bit far from home. For us, we really think at pre-seed, we are a good fit because we consider ourselves sort of uncommon, right? We're unique. We don't come from a financing background, right? Finance background. I'm a music history major who built an angel portfolio, and really comes from the ops and partnerships perspective. That front line of like, hey, I used to be on 1866 calls for Google AdWords, really hearing the struggle of how regular people were trying to use high technology. And I think that's an important place to be, especially for pre-seed, because you are trying to do the unnatural thing of getting this gigantic boulder to start moving a little bit, right? We also both teach at the University of Washington. Minda teaches an angel investing course, as well as the one that kind of goes parallel to creative destruction labs for undergrads and grad students, and I teach with the Master of Science in Entrepreneurship program. So for us, those roles let us really test our understanding of this hard business of startups, right? As John said, it gets easier to sort of identify the 90% that's like super iffy, right? That's the easy part. It's really then figuring out, okay, of the remaining, what could happen? Where are the opportunities? Where are the outliers? And so we love, all this to say, we love this pre-seed stage because it is so analytical. But today, as we talk through investing, the investment decisions at this stage, the analysis doesn't have to lead to paralysis. So we'll talk a little bit about that. One quick note, as with all things you've probably seen through here, this is not investment advice. If you're an investor or an early investor, I think Marty, like this is, this is high risk asset class. Your allocation to the asset class should be should recognize that, right? It should be reflective of that. And we are really sharing our approach and our sort of process. But certainly, like, take some of these, throw away a good chunk of it that you won't, you find irrelevant, and really find ways to apply it to your own process, and just use it as another perspective to add to your arsenal. Cool. So there's a lot of slides here, but and I'll kind of move through fairly quickly so I can leave some time for Q&A at the end. We'll do sort of an Angel 101 recap. If you've been a part of SAC or TAC, certainly this should all start to sound a little familiar to you. I'm sure there are things that John has mentioned in passing or in his little deep dive rabbit holes. So this should tie together a few of these things. If it's content that seems interesting and kind of you want to refer back to, I have recordings of our old Angel 101 workshops, and I'm happy to share that with you. Just shoot me a note. We'll do kind of like a recap, really just to make sure we're sort of setting the scene properly. We'll talk about miracles and fires and what the heck does that mean in a pre-seed context. And then we'll share a little bit about how we apply the framework and, some thoughts on how you might inform your own process. So, okay, quick recap. And also feel free to use the chat to drop questions where you're like, I have no clue what that's about, or hey, dig deeper here, and we'll try to get to the questions there. All right, so most investors know this. John alluded to this earlier with Ivy. Startup investing is great. It can be fun, but it's part of a well-rounded portfolio. It's a high-risk asset class, so you should not be putting in funds that you will really need like tomorrow, right? Now, so that's a small portion. A lot of financial advisors will typically say about 5 to 10%, right? Then within that, how do you reach that 20 to 30 companies? That again, the size of your allocation will dictate what types of opportunities make sense for you. Is it that you should be looking for 5K checks, or could you be doing 25K checks, or is a fund and the diversification with the larger commitment, is that more of a fit for you, or what's the blend, right? And so really think about all the different ways to achieve the allocation within your 20 to 30 companies. Another piece that I always like to remind investors of, right? Sitting on this side of the table, it's very easy to critique, right? But I think what we're really trying, I always try to take the mindset of, you have just walked into an art gallery, you are blindfolded, and the artist is trying to tell you about this like beautiful abstract painting and sell this thing to you, right? And the way they sell that might change based on if they knew that you're an art expert. Yeah, that's maybe a little easier, right? We can talk about styles. We can talk about these like things that tie you to understanding what it is. But I think it's really important to have that kind of empathy of, it's not the founders that are confused, it's us that's blind in this moment, right? So just always a kind of a reminder and an ask that we have some empathy tied to it. Another sort of, I think, important thing to consider, it's very subjective. What I think is a great deal, and that I invest in might be different from what John's looking for, right? So it's there, especially at this stage, there's a lot of sort of murkiness and like, is this the type of risk I like to take? Is this my stage? Like, is this appropriate to what I'm looking for from like performance wise in my portfolio? I guess the first 2 points here is this my investment stage ownership and sector. The first one is what you'll hear John talk about as thesis, right? And that's sort of a little bit also of how the capital strategy unfolds. And the second one is really much more like VC and venture scale oriented too, right? So the liquid exit is typically what we're kind of looking for. Liquid, so that's sort of the bare minimum of what we're looking for. But I think the third point here, and I think often this is for the founders on the call, this is something that I find is a little bit tricky, is the round that you're raising should be helping you kind of get spring loaded to hop to the next lily pad. You'll hear John often talking about like being a little frog jumping across the pond, and you want to raise just enough to get there, not too much, you're in the water, not enough, you're before that, right? But I do think that idea of a little frog jumping is, I think, an apt analogy, because as a founder, it's the thing of, you want to show momentum in your product, in your market signals, in your team, right? One of the founders I was working with at one point, he was kind of he was getting a little stressed because he said, Yoko, we have been trying to add one new customer a month, and we didn't get that one yet. And I was like, okay, cool, like one each month. It's linear. And like, I don't necessarily care about linear growth at this stage. I want you to have no growth for like 2 months, because you've now automated your onboarding. So now suddenly you can take on 5 customers in a month. And then again, now you have 15 customers, right? That's sort of the spring loadedness and the momentum that you're trying to build into the sort of the experiments and the strategy that you're building towards. Valuation and all that stuff could be its own workshop altogether. We mention it for like 2 seconds in our one-on-one workshop, and I'll mention it for like 2 seconds now. I think the important thing to know here is that as an individual angel, you are typically you don't have the leverage to negotiate. It's typically that, hey, these are the terms, and you're in based on that or not. Now, once you have a slightly larger check, with a Seattle Angel Conference or TAC with 150 to 200, maybe there's a little bit of an opportunity to set or help validate it, but it's typically something that you can evaluate as like standard or within the norm or not. But with a typical individual angel check size, you're not sort of like negotiating. Like if somebody says, hey, we're raising on this cap, you're not sort of saying, oh, well, could I get this other cap? So something to keep in mind. The other thing too, and you'll also hear John echo this as you go through Seattle Angel Conference. I remember when I was a fund manager, it can be a point of frustration, right? If you're going through due diligence, you'll feel that soon. But we really want to help you try to separate the economics of the deal from the analysis, right? And so we're talking about the analysis today. But like, just because something is priced above or below, oh man, this is the steal, like that really shouldn't interfere with the analysis of it, of whether it will perform in the way you think it will. Instead, though, the price should also, the other piece is it should inform the potential for your return, right? Is the exit potential too low? This is for founders, this is often when people say, oh, the market is too small. It's really what we're saying is the exit potential is too low. And especially for fund managers, if the exit potential is too low, it impacts sort of our whole portfolio math, right? Because we're kind of in the outlier business. You need to have really outsized returns. So that's the more than 2 seconds I know I spent on valuations, but I think rather than getting into the weeds, it's really kind of thinking about it to those outcomes. If you do want to get into the weeds and you're somebody who loves like understanding all the technical terminology, the Venture Deals book is a great way to actually go through and understand a variety of these things. All right, and lastly, I think this is, let me make sure. I believe, oh, actually, nope, not lastly. Additionally, I think as an investor, right, we all sort of know you should say no far more than you say yes. That is just the truth of it. And I think as you're saying no, right, it's important to let the founder know, like, does it, like, what are the things that would have potentially changed it, right? A lot of times in Seattle, especially, we hide behind like, oh, you just need more traction. Okay. And I hear this from founders all the time. Okay, as people said I need more traction, so I got some customers or I got services revenue, and people still said no. That's really frustrating, right? And so I think it's like you should find some way to indicate whether you would have ever said yes. In what world would you have said yes, right? And that helps them segment their investors, right? The impact piece didn't stand out to me, or there's just not a clear impact in the world. So that's my lens. That's sort of if you said that to a founder who has a very non-impact story, like, yeah, that no is like helps them segment you and say, oh, I was just talking to the wrong person, right? The other thing is, as we go through our analysis too, it may seem like there's a lot of sort of wondering that we're doing, and a lot of research that we're doing, but we're often not doing that on founder time, right? I think of founder time as really precious. It's the one thing that none of us can get back, right? So, I'm all, do the work up front to know what are you looking for, what are you listening for, and do a lot of the hours of research and work that you're doing is probably on your time, not on their time, if that makes sense. And then lastly, yeah, I actually find like this is about long-term relationships. This is just one transaction amongst a long-term interaction with this person, right? A long series of interactions. For us, the founders that we pass on sometimes send us amazing deals later on. So I do think that it's that if you find some value in a founder and their perspective and what they think, even if that current transaction isn't for you, certainly you can keep that relationship healthy and warm by treating it as such. Let's see. Alrighty. And then I think the final thing too to keep in mind at this stage, and especially those of us, I was at Google, and there's a bunch of, I think there's a good number of Microsoft folks in here too, and Meta. Pre-seed deals do not look like what you expect. Sometimes there's no spreadsheet that tells you, yes, this is a winner. And certainly there's like a million ways that a company will die. This is always the case, right? Pre-seed is that there's this huge immovable boulder and you're just trying to get it in motion. So instead, I think as investors, you're trying to uncover things like, well, one is you're trying to understand this founder and say, like, do they have integrity? Do they have the grit and sort of the ability to push through those walls? Do they have curiosity, right? To find curiosity and experimentation. And this is different from curiosity that is just like, I go chase down every kind of weird little thing on the edge. No, but I think a curiosity, you go, oh, that's interesting. Like, it didn't work how I thought. Maybe, so a little bit different where there's some intention and sort of goals behind that curiosity, but there's an openness to know more. And what's the full potential when everything goes right? Right. This is sort of like the miracles. What are the miracles? If all the miracles came true, what's that huge thing on the other side? Right. And again, huge is relative, perhaps. For angels, you might be really excited about a 4x outcome. For us, the potential has to be in a different scale. And then what stands in their way? Like I said at the top of this slide, like, there's a million ways that a company is going to die, but like, what are the sort of like the key things that might stand in their way, and how might you mitigate those? So at the core of it, I think when you're looking at a deal, those are the three things that you're trying to understand. And when you have that kind of those sort of end points in mind, it helps you understand which questions to ask and which signals you're seeking. Okay, cool. I'm going to pause here and I'm just taking a quick peek at the
I think the main
questions.
one is Prashant's question at the end.
Okay. What good looks like. How should you hone your expectation? What is good traction? Which is, okay, totally. This is, that's a great question. And I would say this is also why Seattle Angel Conference can be a really good starting point, right? Because part of it is, what's frustrating is it really only comes with some volume of deals you've looked at, right? So as an individual angel, right, my first angel check was in a company that my husband's old gym buddy was doing, right? Our second investment was an old colleague of mine, right? And so it's one of those things where it was partly because it was a close network, right? But beyond that, the reason why I did Seattle Angel Conference, because I was like, okay, like my friends are fantastic and great, but that's not a good enough pipeline for me. And I need to understand more about how to actually do this. And so that's really why Seattle Angel Conference compelled me in. And think about it, on day one of Seattle Angel Conference, you look at 50 to 75 deals. How many deals was it at the beginning?
We had 86 this time.
86, right?
Yeah.
You get 86 pitch decks dropped in your lap, right? That's a heck of a lot of deals to parse through. And I think that sense of sort of volume of having looked at multiple times of a deck or multiple decks and just looked at like, okay, what you'll start seeing is some sort of repetition of themes of like sectors that people are looking at, or certain kind of like pockets of application of AI, for example, right? And so I do think that helps you get some fluency in what is sort of standard. So one is just like increasing the deal flow for yourself in various ways. Angel groups, funds, and networks can be a great way to do that. The second bit too is I think Minda, when she was starting angel investing, one of her mentors told her, like, just look at a bunch of stuff, but don't invest for at least a year. I would probably have said 6 months, but a year, right? Like, and so be willing to stand on the sideline and like let things go past. Because part of that, what that tells you is a deal that she looked at in month one, right? She might see what happened to it, right? You should consider track it a little bit. And so you sort of start to, I think you get better as you just see more kind of pathways emerge. And I would say the third piece is talking to other investors. I think communities like this, as well as some of the angel communities in Seattle, are really great because you can sort of say like, "Hey, is this normal? This company has no traction and they're raising at a 20 million post. Like, is that normal?" It's like what might need to be true about this team or about the area they're in that would make that normal. Right. So I think community and finding folks to ask that question of is important. Hopefully that helps.
Joan asked the question about how do you do the due diligence and how do you get the founders and all of that, which is what SAC and TAC are all in the middle of doing exactly right now.
Yeah. With diligence, and we'll talk about process and how we're doing that. And I saw James, you have a question too about AI and how that works into our process. So I'll talk about that in the not this section, but the one after that. Well, I'll move a little bit forward here. So everyone knows this, the business model canvas on the left, right? And really, I think that what we like to think about is like, hopefully as a pre-seed founder, they have done this sort of initial canvas process. Everything is theoretical, right? But we think about that as the blueprint to this 3D machine, this money-making machine on the right, that once it gets going, it runs on customer revenue and it's repeatable and infinitely scalable, or maybe not infinitely, but it's repeatable and scalable. And so we think of those miracles and fires as almost like it's like a heat map overlay, right? Of like what needs to happen to sort of like translate this 2D blueprint into the 3D machine. And for us, we think about miracles as things that must unfold, things that sort of the things that need to be come true. And then the fires are the things that you need to prevent. Minda is more familiar, I would say, with this particular analogy, but I believe she connects it to the Princess Bride, and the fires are the fire and like going through the fire swamp, right? So sometimes you're trying to like avoid the things that are, and then but part of it is also you just have to find the path through. Right, the map, I think when we talked about earlier, right, this business model canvas, if that's the map, it's not necessarily like the territory. It doesn't tell you how steep of a climb is that, how muddy is that over there, right? And we think about the miracles and fires as truly sort of the most venturable part. If everything was a linear path, and like if I have a perfect business model canvas, I can like build a venture scale business, then I would say venture capital and this business we're doing here would not even exist, right? So the venture part of venture capital is truly because of these miracles and fires and sort of the things that both need to unfold and be prevented. And so when you're thinking through that, right, and understanding the miracles and fires, it's important to ask, like, what needs to happen for this company to succeed, right? And I'll take a pause here. If typically the innovation is happening with something with the business model, or the market. If it's a life science or deep tech innovation, it's a little bit different because there's this whole other work of actually being able to actually make the technology work that happens. And I think that's before this, but this is really much, we think much more on like the market validation and sort of the customer or the market response to the innovation. And so this, I think the second point, the scalable business model powering value prop, that this is a point where like SaaS, obviously it's kind of this like, once you build it, then there's your customer acquisition costs and your lifetime value sort of come into a better ratio. But this is sort of where, like, if it's a services business, much harder for that to really scale the scale with your value proposition, right? So it needs to be the business model fit there needs to a business model fit with your sort of with the value prop, with the type of capital you're taking. And then then you have to conquer the external forces are really more of the fires, right, that exist out there. It might be related to capital requirements. You need a ton of capital first, and that ton of capital needs a ton of signal. Or it might be that there's incumbents as well as other market forces that are sort of like stopping your way. But these are sort of the rocks and the pitfalls and the things that happen as you're trying to build this large outcome. So when you think about, and I think not all of these will matter for a particular company, right? But maybe it's a team that has never worked together and they met on a startup co-founder like matching site 2 weeks